Hungary's possible withdrawal from the European Union has become one of the most discussed subjects in European politics. While the idea of regaining full sovereignty appeals to some, the true cost of such a decision would be enormous. Leaving the EU would not only involve financial settlements, but also decades of economic and diplomatic restructuring that could change Hungary's entire future. To begin with, Hungary is one of the largest net beneficiaries of EU funds. Between 2021 and 2027, Hungary is expected to receive more than 40 billion euros in grants and loans from the European Union. These funds support infrastructure projects, agriculture, innovation, education, and healthcare. Every road renovated, every industrial park developed, and many new schools and hospitals have some level of EU financing behind them. Walking away from the Union would immediately cut off these inflows. The European Commission estimates that EU funds account for nearly 4% of Hungary's annual GDP. That means without these contributions, Hungary's economy would contract instantly. The government would need to replace the lost funding from domestic sources, which is nearly impossible given the size of Hungary's current budget. The country's public debt already stands at over 70% of GDP, and financing new programs without EU support would require more borrowing or higher taxes. In addition to losing subsidies, Hungary would likely have to pay an exit bill similar to what the United Kingdom paid during Brexit. The UK's settlement was around 45 billion euros, covering its share of commitments made before withdrawal. Hungary's share would be smaller due to its lower economic size, but analysts believe it could still reach 10 to 15 billion euros. This payment would be necessary to settle financial obligations in the EU budget, pension liabilities for Hungarian citizens who worked in EU institutions, and other legal commitments. Trade is another massive issue. More than 75% of Hungary's exports go to EU countries. That includes vehicles, machinery, electronics, and agricultural products. These goods currently move freely across European borders without tariffs, customs, or regulatory barriers. Leaving the EU would mean exiting the single market. Overnight, Hungarian exports would face customs checks, import taxes, and lengthy border delays. Even a small tariff of 5 to 10% could make Hungarian products less competitive, especially in the German automotive market, which is one of Hungary's largest partners. Foreign investment would also take a heavy hit. Multinational companies have poured billions into Hungary precisely because it offers access to the EU market. German car makers like Audi, Mercedes-Benz, and BMW established massive plants in Hungary due to its low labor costs combined with EU membership advantages. If Hungary were to leave, investors might relocate production to other EU states to avoid trade barriers. This could cost tens of thousands of Hungarian jobs and billions in lost tax revenue. Financial markets would react immediately. The Hungarian forint would likely depreciate sharply against the euro and the dollar, increasing import costs. Inflation would rise as the prices of fuel, food, and manufactured goods go up. The central bank would be forced to raise interest rates to stabilize the currency, which would slow economic growth even further. The forint's fall would also make foreign debt more expensive to service, putting pressure on the government's budget. The social consequences could be equally severe. Hundreds of thousands of Hungarians currently live and work in other EU countries, enjoying freedom of movement and employment rights. Leaving the Union would put these privileges at risk. Hungarian citizens might need visas or work permits, and recognition of professional qualifications could become more complicated. Remittances sent home by Hungarians working abroad, which contribute significantly to the domestic economy, could decline as a result of new restrictions. Politically, Hungary would face a new level of isolation. The European Union is not just a trade bloc, but a political alliance that provides collective power on the global stage. EU membership ensures Hungary's voice in decisions on climate, energy, security, and defense policy. Leaving the EU would mean losing that influence and relying solely on bilateral relations. Hungary could seek closer ties with countries like Russia, China, or Turkey, but none of these relationships would replace the financial and political weight of the EU. The cost of rebuilding independent trade agreements would also be immense. Hungary would need to negotiate new deals with every European Union member state and dozens of third countries that currently trade with the European Union as a bloc. This process could take years, possibly more than a decade. During that period, uncertainty would discourage investment and slow growth. Another major factor is the impact on Hungary's currency stability and credit rating. Moody's, Fitch, and Standard & Poor's would likely downgrade Hungary's credit score immediately after announcing an EU exit. A lower rating would make borrowing more expensive for both the government and businesses. It would also discourage foreign investors from buying Hungarian bonds. The resulting increase in borrowing costs could add billions in annual interest payments. The agricultural sector, which employs hundreds of thousands of Hungarians, would be particularly vulnerable. EU subsidies currently make up more than half of the income for many farmers. Without these supports, food prices could rise sharply, and smaller farms could go bankrupt. The Hungarian government would face enormous political pressure to replace these payments, adding another burden to the national budget. Tourism might also decline. Hungary benefits from being part of the Schengen zone, which allows free travel across most European countries. Exiting the EU could mean leaving Schengen as well, leading to new border controls. Fewer tourists would visit, and airlines or travel agencies could adjust routes and prices due to new regulations. The long-term impact on innovation and education would be significant too. Hungarian universities and research institutions currently receive EU grants for science and technology projects. These funds support scholarships, partnerships, and laboratories that keep Hungary connected to global innovation networks. Leaving the EU would cut off access to these programs, making it harder for Hungarian scientists and students to participate in international collaborations. Analysts estimate that the total cost of Hungary's exit from the European Union, combining financial settlements, lost EU funds, and economic contraction, could exceed €50 billion within the first 5 years. This figure does not even include the longer-term effects on productivity, living standards, and global competitiveness. Over a decade, the total loss could surpass €100 billion. Economists at the European Policy Centre in Brussels warn that leaving the EU could reduce Hungary's GDP by as much as 10% in the first 5 years, and up to 15% in the long run. Such a decline would reverse 20 years of economic growth and push Hungary into a severe recession. The loss of investor confidence would also affect Hungary's financial institutions. Banks operating in the country might relocate their headquarters to European Union states to maintain access to European markets. That would mean job losses in the financial sector and less credit available for Hungarian businesses. There would also be legal complications. Thousands of Hungarian laws are aligned with EU directives. Upon leaving, the government would need to rewrite or replace many of these regulations, a process that would take years and require thousands of legal experts. Businesses would have to adapt to the new national rules, adding to costs and uncertainty. Another often overlooked consequence is the weakening of consumer protections. EU membership guarantees strict standards for product safety, food quality, data privacy, and environmental protection. Leaving the Union could lead to weaker safeguards and less oversight. Consumers could face higher risks and limited options if companies move operations elsewhere. Diplomatically, Hungary would lose access to the EU's collective negotiation power. When the EU negotiates with major powers like the United States or China, it does so as a single market representing over 400 million consumers. Alone, Hungary's bargaining position would be much weaker. This would affect trade, investment, and even foreign policy. Hungary would also lose access to the European Stability Mechanism, a financial safety net designed to support member states in crisis. Without this, if Hungary faced a recession or banking collapse, it would have to rely solely on the International Monetary Fund or its own reserves. This lack of support would make the country more vulnerable to financial shocks. Critics of EU membership argue that leaving would restore national sovereignty and allow Budapest to make independent decisions without interference from Brussels. While this argument appeals to some voters, the economic data shows that sovereignty would come with a heavy price. Independence in a globalized world means less influence and more vulnerability. Even countries outside the EU but dependent on its market, like Norway or Switzerland, still follow most EU regulations to maintain trade access. They pay into the EU budget and accept free movement rules without having a vote in Brussels. If Hungary left and later sought similar arrangements, it might end up following EU rules again, but without any influence over how they are made. In the short term, leaving the EU could also trigger internal political instability. Businesses, labour unions, and opposition parties would likely protest against the government's decision. Public opinion polls show that a large majority of Hungarians still support EU membership, mainly because of the economic benefits. A sudden withdrawal could therefore lead to social unrest, demonstrations, and a deep political divide. In conclusion, while the idea of Hungary leaving the European Union may seem appealing to those frustrated by political disputes with Brussels, the financial and economic consequences would be catastrophic. Hungary would lose billions in EU funds, face massive exit payments, suffer a sharp economic downturn, and risk long-term isolation from Europe's largest market. The total estimated cost could easily exceed €100 billion over a decade, transforming Hungary from one of Central Europe's emerging economies into a struggling, isolated state. Every indicator, from GDP, employment, investment, and inflation, suggests that the price of leaving the EU would far outweigh any perceived gain in sovereignty. The lesson from Brexit is clear. Even a wealthy nation like the United Kingdom faced years of economic disruption, inflation, and political division after leaving. For Hungary, with a smaller economy and higher dependence on EU funds, the consequences would be even more severe. The real question for Hungary is not whether it can afford to leave the European Union, but whether it can survive the shock that would follow.